I'd like to just start by asking you to describe the Committee on Capital Market Regulation in terms of just basically what it is and what it does.
Well, it was created in 2006, about the time that Paulson became Secretary of Treasury, focused on the competitiveness of U.S. capital markets. He asked us to write a report on that subject, which we did in November. Unfortunately, any steam behind doing things we recommended got overtaken by the financial crisis in 2007.
Right.
The committee is co-chaired by John Thornton and Glenn Hubbard, about 35 people, drawn, I think, uniquely from all segments of the financial world. So not only banks, hedge funds, private equity, buy-side, mutual funds, a very high level of people. We have also maybe 5 academics, bipartisan. Thornton's a Democrat, Hubbard's a Republican. We have a number of Democrats on the committee. We try to do things based on, facts, research, and we make use of resources here at Harvard to support it. This is totally independent from Harvard. It's a completely separate entity, but there are a lot of resources here at Harvard that we can provide.
Okay, great.
So that's basically it.
So let's start our discussion about with the financial crisis, and from your standpoint, the 3 or 4 causes. I mean, obviously there's a lot of discussion, has been a lot of discussion about the causes, but I'm interested from your particular standpoint, if you had to say at least these 3 or 4 things were responsible for the crisis, what would you come up with?
Well, Jeff, I'd first like to divide the crisis into 2 parts, because I think there were really 2 crises.
Okay.
So the beginning, the first crisis, was basically caused by plummeting housing prices and bad loans, which became bad in large part because of the plunge in housing prices. So that was the first crisis. So that created a lot of loss in the system. The second part of the crisis, which in some ways was worse than the first part, was the contagion panic set off by the failure of Lehman. Okay. And so that's when this crisis manifested itself in the middle of the financial system. Yes, a number of lenders had losses, but we weren't looking at the collapse of the financial system over that.
Right.
That really was kind of started with Lehman, and then the inability to upfront stop the contagion that was set off by Lehman's bankruptcy.
Now, there has been a huge amount of regulation, or regulatory response to this. I'd like to divide this into, first of all, where you think the regulatory response was sort of well conducted, and then secondly, where you think it went off the track.
Well, I think the strong part of the regulatory response was aimed at what I would describe as the problem of connectedness. Although I don't think it was nearly as important in retrospect as we thought it might be before, but the idea here of AIG fails, Goldman fails, it's sort of this chain reaction set off by the connectedness of institutions. And I think we responded pretty well to that. Central clearing, big innovation. Yes, there are dangers with it, but I think overall it's a big improvement. Counterparty exposure limits, again, aimed at the same thing. Those are kind of what I call asset connectedness. There's also funding connectedness. That is, when big funder fails, this is more what the economists focus on in network theory. So you take a lot of funding out of the system, and what happens then? This is the tri-party repo problem. Again, that wasn't a problem in the crisis, but I think we became sensitive to that, and we've tried to reform that and other sort of funding dependencies in the system. So I think that's all good. I think, secondly, resolution, a big plus. Lots of problems with it, not ready for prime time yet, but the idea that we should be in the position to, A, resolve large financial institutions, which we, outside of bankruptcy, because I do not think bankruptcy is the way you can deal with these situations. That's all good. I think there are a lot of problems with the resolution procedures, but going down that road, it gives us the prospect of ending too big to fail, which I think would be very desirable. So I think those two are, in my mind, the top things we've done.
Now, how about where do you think that regulatory response was? Let's call it ill-advised, or where there was.
Jeff, I want to add a third.
Yeah, please.
Inadvertently left out. Capital requirements, better definitions of capital, more capital. I think we risk going too far, but we hadn't gone far enough before. So definite need to increase capital. The issues there is, have we gone too far? But we were woefully inadequate before the crisis. So I would say central clearing, resolution, and capital were the three strongest and best responses to the crisis.
And if I'm right, the underlying problem that these were designed to deal with really has to do with the interconnectedness of the system, the potential for contagion.
Well, I think we need to distinguish, and this is really important to how I view all of this, between connectedness and contagion.
Okay.
So the connectedness scenario is A fails, B fails, because B is connected with A. Or on the funding side, A fails because B can't fund it anymore. Okay, so you've got asset interconnectedness and liability interconnectedness. Not the major problem of the crisis. Okay?
Right.
The problem in the crisis was panic runs. That's contagion. So this doesn't really depend on connectedness. So when Lehman went into bankruptcy, we had a little connectedness with the Reserve Primary Fund because they were loaded up on Lehman commercial paper. But as you well know, the panic spread way beyond the Reserve Primary Fund to the entire prime institutional money market fund sector, and then way beyond that to all short-term funding. That was panic. That's like a classic run. It manifested itself in the banking system, in all other areas of the economy that were dependent on short-term funding because people withdrew their short-term funding and didn't want to increase it. So that's really not the same phenomena as connectedness. Some economists think, in fact, you could set off contagion with sunspots. Who knows what really triggers contagion? It's a psychological phenomena that creates panic. Okay, and to me, that was the most difficult problem in the crisis, and a lot of attention, obviously, will come to that, was focused on how to contain it.
So you have identified sort of three areas where that could strengthen the financial system, if done well. But there have been a lot more regulatory moves. So I'm thinking that by implication there are others that you feel we've gone down the wrong road.
Yeah. Let's take one, to me, totally clear, the Volcker Rule. As you know, that was not part of the Treasury's recipe for reform in their white paper. There was no international consensus behind that. Came shortly after Scott Brown's surprising election here in Massachusetts. It's a populist initiative. It basically controls two things: proprietary trading and by banks, and limits their investment in private equity or alternative investments like hedge funds. None of that had much or anything to do with the crisis. So I actually think it's counterproductive for the stability of the system in two ways. First of all, it deprives banks of a diversification element in their business, trading versus lending, and it pushes out this somewhat risky, but still, I think, useful activity out into the unregulated shadow banking sector. So I think I can only view that as a political, populist initiative that really wasn't addressed to any of the real causes of the financial crisis. So that's very counterproductive, I think. Another, I think, questionable, very questionable approach has been SIFI designation. Now, as you know, with banks, what we did is we said all banks over $50 billion are automatically regulated by the Federal Reserve and as such subject to enhanced supervisory controls, particularly capital, more capital than other banks. But in the area of non-banks, what we've done is we give an FSOC, this group of regulators chaired by Treasury, the power to designate certain non-bank financial institutions as so-called SIFIs, systemically important financial institutions. And the consequence of that is that they go over to the Fed and are regulated by the Fed. And so far we've designated G Capital, Prudential, and AIG, and we're in the midst of dealing with MetLife. So we've got G Capital, basically a bank anyway, 3 insurance companies. So I think that's we have flirted with the idea, although I think we've gone off in a different direction now, with designated asset management companies. From the last maybe 6 months, there's been this huge battle over the possibility that firms like BlackRock and Fidelity would be designated. I regard that as all very bad because, first of all, I don't think where we've designated insurance companies, they're really systemically important. That is, in the sense that their failure could really impact the financial system. AIG was a problem because it was engaging in non-insurance activities at the holding company level. And that's very undesirable because the states which do regulate the insurance companies do not regulate the holding company. So nobody was regulating the AIG holding company except the Office of Thrift Supervision, which was like almost nobody. They owned a small thrift. So I don't think you can, so for insurance, I don't think they're systemically important. And I see the same thing with asset management companies. And I think that's why we've said, no, we're probably not going to do that. The issue is activities and products, not firms. And so there was discussion of this during Dodd-Frank, and we kind of didn't do that. We went over to the SIFIs. So I think we need to drop SIFI designation and focus on what are the activities and products in the financial services industry that need to be controlled, and not designate firms. Okay, so I think that's a very bad approach. So Volcker, SIFI designation.
Let me just ask you. Let me ask you on the SIFI.
Sure.
Are you saying that the focus on products and activities that should also replace the designation of the
Yes.
big banks? In other words, scrap.
No, of the big. No, because I think what we did with the big banks are 50 billion plus, and now, as you may know, there's a big argument where maybe that's too low a number.
Right.
You should have 100 billion because we're kind of getting too many. I think no. I think because when we designated banks, we're subjecting them to banking regulation as done by the Federal Reserve. When we designate insurance companies, okay, we are now subjecting them to
Right.
who knows what regulation by banking regulators, okay?
Okay.
Which doesn't fit the insurance company. So I'm okay with the certain size of banks. I think it might have to be higher than 50 billion. They should be over there supervised by the Fed, but I don't think we should be naming other non-bank financial institutions.
Okay. So you have the Volcker rule. You have the SIFI designation for non-banks.
Right.
Are there other areas that you would feel that are ill-considered?
There are a lot of areas, and I already mentioned this with capital, where the direction's good, but I'm afraid we go too far. Okay, so how much capital should we require? What is the cost of requiring this capital to the banks and ultimately to the real economy if, because of these higher levels of capital, we constrain lending and other things that we want to see banks do? So I think that's bad. I think the worst thing that we've done is in the post-anti-bailout world. And bailout now means not just TARP, it means deposit insurance, it means or elevated deposit insurance, and it certainly means lender of last resort. Dodd-Frank restricted all of these things. And these were the things that actually stopped the second part of the crisis. Okay. So if you look at what happened after Lehman, and we had the panic and short-term funding, the Fed massively responded to that by not only creating liquidity in the banking sector, but also in the non-bank financial institutions. It lent to the banks to loan to the money market funds. It lent directly to what were formerly and for some time still investment banks before they converted to banks. It even bought commercial paper of companies on an unsecured basis, okay? And it was all of those efforts that really stopped the panic. When we got to TARP, we had, and the liquidity of the Fed was ongoing then, but we had a couple maybe institutions that were insolvent. We didn't want to identify them, so we injected capital in a lot of institutions. But by that time, even though the market didn't really understand this, the liquidity lender of last resort function that the Fed had exercised basically stopped the panic and the run. FDIC, in the crisis, increased transaction account insurance to anything and raised insurance on the normal other accounts from what was then $100,000 to $250,000. And also guaranteed senior debt because a lot of these institutions just couldn't issue junior short-term debt, so they guaranteed that. Geithner thought that was very important as well, and I agree with that. And the Treasury guaranteed the money market funds. Okay, so this was the massive response that stopped the panic run contagion. What did we do in Dodd-Frank? Okay, we restricted the Fed's power as lender of last resort to non-bank financial institutions in a number of ways. I think the maybe three most important ways were, one, we said you can only do this now in the future with the approval of the Secretary of the Treasury. Okay, so we have made the Fed, before it would ever do in 2008, what it did to get the approval of the Secretary of Treasury. 2008, not a problem. Paulson was Bernanke's cheerleader. But we are now in a post-anti-bailout world. Think of Rand Paul as president, or Jeb Hensarling as Secretary of Treasury. That approval is not for sure, okay? And even though if we walked up to the precipice and you said to these people, look, we're going to have rioting in the streets unless you approve this, the market's going to be edgy about whether they're going to approve, okay? So the panic will accelerate, and you will not be able, in fact, to deploy these weapons in advance of the panic, which we should have been in the position in 2008. To make a pun, the Fed invented these mechanisms on the run. As the run was going, right, they were increasing their power as a lender of last resort rather than say, here are the bazookas, they're all ready to go, don't panic, we'll take care of it. Mario Draghi will do what it takes. That's the position we should be in. So, secondly, it said in Dodd-Frank that they could not loan to a single institution as they in fact did with AIG. Panic starts somewhere. There's always a first institution, the victim of the panic. Now, maybe there's a workaround with a cooperative Secretary of Treasury says, I'll approve a broad program, and under that program you can loan to the first. You'd want to do that in advance. Again, the political force is very difficult. And third, it said, higher collateral requirements, okay, and better reporting to the Congress. You've got to report, I think, in 7 days if you make a loan to a non-bank financial institution, which carries the stigma problem. That, I'm not going to borrow because I'll be stigmatized. So, lender of last resort to non-bank financial institutions significantly restrained by Dodd-Frank. Secondly, the FDIC the powers that they exercise to guarantee senior debt, to raise the insurance limits, taken away. They did that on their own in the crisis. They didn't go to Congress for approval because they had existing authority to do that. Congress took that away. But not to worry. If you get a joint resolution of Congress, you can still do it.
Right.
You know, how practical in a timely way is that? And then the guarantee the money market funds by the Treasury. That was done through a creative use of the Exchange Stabilization Fund, which has been used to help currency rates in Brazil and Argentina, or in Mexico, Brazil and Mexico in the 80s. That was taken away. So what I'm saying, Jeff, is all of these weapons that we used to successfully control contagion, which were actually weaker than they should have been, because they should have been an advance deployed, don't worry, don't panic. Lima went bust, you're okay. Restricted and taken away. So our system is much more vulnerable today to contagious panics than it was before, and there's no prospect of fixing it, because this is toxic. Anybody who raises their hand and says, we need to strengthen the Fed's lender of last resort authority, we need to give FDIC more power, how about giving the Treasury the ability to guarantee money market funds? Oh, you want to bail out Wall Street again. So it's toxic, okay, because of the populist anti-bailout rhetoric that has been employed, and lender of last resort's the same as TARP. Nobody's making a distinction here. So I think that's the worst thing Dodd-Frank.
I want to ask you about the international arena, but before I do, let's just follow your line of thought here. So what I hear you saying is that, in theory, some of the interconnectedness is in the process of being developed. However, we have taken away the ability to intervene in a very forceful and very timely way, and therefore, at best, these two cancel one another out. That is, or let me put it another way.
I think it's worse than that, because interconnectedness was about this part of the problem.
Right.
Contagion was this. Okay. So we've improved our response here, and we've really decreased our response here, okay, right, which was the big problem, okay. And what can sink your financial system and sink you, the country, is panic and rioting and uncontrolled fear, all right? That's why we invented the Fed in 1913. By the way, it took us a long time, because we had huge debates in this country over the first national bank and the second national bank, the idea of giving any government institution some kind of control or lending power into the private sector. We said, okay, J.P. Morgan can take care of this. Well, in 1907, he couldn't. And we had a deep recession. We had a panic. And that's led finally to the Fed in 1913. They weren't created to do monetary policy.
Right.
They were created to stop this kind of problem. And so here we are today, where that very function is again under severe attack, is being constrained, and therefore I think the prospect, if we go into another crisis of the same kind of panic variety, we're not well suited to deal with it. That's a big deal.
From a historical perspective, if you think about a regulatory pendulum, always swinging to extremes, where do you think we are now? Has this pendulum gone as far as it's going to go, or do you actually think it could continue to move in the current direction for a couple of years or longer?
Again, I want to distinguish between here regulation and lender of last resort, because they're different. So in terms of regulation, capital requirements, liquidity requirements, local structural change, all of those, I think the pendulum has swung about as far as it's going to swing. Okay. And we'll be seeing a correction. How much, I don't know, but we'll see something. On this other question of the legitimacy of the Federal Reserve, I don't know, because the politics of that are sort of, oh, you want to bail out Wall Street again. Public money. Now, we know that a lender of last resort is extending, in effect, public money, okay, to the banks and to non-banks to stop contagious runs. But the politics of this are very difficult. And I just see, as long as somebody can say to you, Jeff, if you advocated strengthening the Fed, you're trying to bail out Wall Street, when is that going to stop? When is that rhetoric going to stop? The only thing that's going to stop that is we go into a panic and we have a depression and there's rioting in the streets and say, oh, that didn't work. We got to have a strong Fed again. Otherwise, I'm kind of pessimistic of how we turn that rhetoric around.
Okay, let's go to the international arena. There certainly has been a lot of activity, a lot of meetings, and some of the things you're talking about, that you've been talking about, like capital requirements, resolution, clearing houses, they all have a very strong international dimension.
Yeah.
So how do you assess, starting from the let's say 2009 or 2008, 2009, the amount of progress that's been made to have a viable international regulatory structure? How much of it is smoke and mirrors? How much of it is real? And where do you think we are in that pendulum?
In some ways, the most surprising element of the response to the crisis was that we were able to get international agreement on so many issues. And when the Treasury, my committee wrote a report in 2009, I think maybe March, April, and then the Treasury came out with a white paper in May, I think. And the Treasury's white paper, which was their blueprint of what needed to be done, typically there's no mention of international. In fact, that's like a bad thing. You don't want to say, we're doing this for the United States and international. But the last chapter of that white paper was all about the fact that everybody was on board for what Treasury wanted to do in the U.S. That was incredibly surprising. Okay, now a lot of work had to be done to prepare that. So, and as I said, Volcker wasn't part of it, but all these other things we're talking about, capital, liquidity, resolution, are all there. Okay, and the Treasury white paper agreed to, basically in principle, international. That's very amazing. And at the same period, of course, this whole crisis was a huge concern for the G20. It was not just a U.S. matter. What was the talk shop of the Financial Stability Forum became an operating entity to exercise the will of the G20, renamed as the Financial Stability Board. So we already had the Basel Committee for Capital. We had no real coordinating secretariat or entity to implement regulatory policy more broadly in the Financial Stability Board. So Financial Stability Board has become a very important institution. And it doesn't have a big staff. It doesn't have a lot of money, but it can command all the resources of G20. Somehow they're able to create committees with the resources of individual countries working together, not employees of the Financial Stability Board, because countries are kind of worried we don't want to create this international global regulator. They function, I think, very well. And they have been issuing high quality, in my view, analysis. There are issues with it, the lack of transparency. But I'd say generally we made a tremendous progress over here on the international front. Look, these problems are global for the most part. So to have an intelligent response, you needed to do it on a global basis. We're not ready for a global regulator. Okay, the UK is hardly even ready for the EU. We're not ready for that. But we've made steps here, okay, towards that, which I think are productive. Most financial institutions like this because they don't want to be subject to conflicting regimes. They would like one regime that they can comply with. And we're moving in that direction. Now, there are problems. There are problems with everything. We have a number of issues where the U.S. and EU don't see eye to eye, particularly in the derivatives area, to some extent in the capital area. Asia says, what's this all about? All the stuff that you're talking about is really Western problems. You know, why should China do any of this? Japan has a very stable system. We'll bail out anybody over there if we have to. We don't have this anti-bailout, protect the taxpayers mentality. Why are you foisting this on us? All said though, okay, we have made tremendous progress here in moving towards a more coordinated international response, which I think is very good.
How much of that progress do you think is a result of, let's say, formal agreements, and how much of it is a result of people actually getting to know one another, understanding how their systems work, and the hope that in another crisis they would be able to communicate better, move faster, somehow mesh their various systems, but it's a long way from any kind of sort of regulatory harmony in law.
There's a big piece of that. I think that's very important. So your counterparts, and that I think helps coordinate responses. Again, we've got a long way to go to make it better, but I think this is the right direction, and we've made significant progress.
So, my final question is, looking forward. Now, we are where we are, and this in the United States, this sort of anti-bailout mentality runs quite deep. Runs in both parties. In a new administration that, let's say hypothetically, decides to review, where have we been, and where are we right now? So let's say, the year is 2016, and I'm assuming an administration of goodwill and real sincerity about making sure this kind of crisis doesn't erupt on its watch. And they call you in and they say, you have been watching this and studying this, and your committee is comprised of people who have all kinds of experiences. If we could do 3 or 4 things that would really be constructive. I'm asking you really for your personal opinion, you're not necessarily representing the committee. What would you say? What would be the agenda starting from where we are now?
Number one on my agenda, again, I don't think the president will accept my views because of what I've already called the toxicity of this issue. But number one on my agenda would be to strengthen the Fed's ability to function as lender of last resort. Okay. That would require us to undo a lot of the restrictions we placed on the Fed and Dodd-Frank, and in my view, give them even more power, okay, to be a lender of last resort and an effective one. The Fed is very vulnerable. Think of comparing it with the European Central Bank. The European Central Bank was created by a constitution, the Maastricht Treaty, okay? And there are no crazy congressmen running around shooting at them every day. So they have tremendous independence. Our Fed's created by Congress. It can be destroyed by Congress. So they're vulnerable. The whole research on Federal Reserve independence was focused on from the Treasury of the Fed. That's not the problem. The problem is Congress and the Fed. Okay. So I would say to the president, you have to strengthen the Fed as a lender of last resort, undo the restrictions, and almost all the restrictions Dodd-Frank placed on them, and give them more power. I would say to the president, the FDIC, this is lender of last resort on guarantees. If we look at the level of insurance, which was another contagion fighting idea that came out of the Depression, deposit insurance. People are insured, they don't run. And in the panic, we, increased that all. I would at least go back, okay, and restore all those powers to the FDIC. But the fact of the matter is we're still in the position where more and more short-term liabilities are outside the banking system.
Right.
Look at the, money market funds where the panic really started. Floating NAV, redemption restrictions, which is what the SEC did for money market funds, not going to stop contagion of money market funds. Only one thing will stop it: insurance guarantees. I'd say you should explore that. Okay, I'm not sure how it will work, but we have to come to grips with the fact that short-term funding is way out, out of the banking system. I think I would also say to them, and there's some element of the Fed thinking about this, can we design our system in general so we're less dependent on short-term funding without increasing the cost, okay, of the financial system significantly?
Could you
Could
you say that again? Your voice faded.
We should, could we design the financial system in a way where institutions were less dependent on short-term funding? Okay. And there are many different ideas about how we could do that, and I would say the president. So all of these are aimed at contagion.
Right.
Okay. Increasing our ability to respond to it, and maybe decreasing the likelihood that it will happen. That would be. And then the second thing I would say to the president: we have the worst regulatory structure in the world. We can't even merge the SEC and the CFTC. It's ridiculous. I'd say almost anybody would say the higher quality is in the SEC than the CFTC. They got more people, they got better people. Yet the fact is that the CFTC is regulating 95% of derivative transactions, and the SEC is 5%. It's crazy, okay? And they're doing it separately.
Right.
So let's really go back to the Paulson Blueprint and all of these efforts that we have made periodically, and our committee has recommended things to, redesign the system, consolidate the regulatory structure. We have state regulation of insurance. Isn't that a little outmoded? Okay, shouldn't we at least have an optional federal charter system? So I think we really need to, let's say the president, you really need to reexamine the structure, because FSOC is not the answer. Okay, having some Treasury shared group of people, all of whom have independent authority and don't have to listen to the Secretary of Treasury because they're independent agencies, isn't going to work, and it hasn't worked. So we need to reform our regulatory structure, deal with contagion, and get a better regulatory structure. Those would be my two biggest priorities for the president.
Well, that's fascinating. When I hear you talk, I cringe a little bit about the sort of the political hurdles, because everything everything you say has some logic, a lot of logic. The question is there any political upside for anyone? You're really saying, I mean, see if I have this right, that there is a huge collision here between what is necessary for financial stability and the political incentive to move in that direction, absence, as you said before, another crisis of even greater proportion. That is, we haven't, and as far as time goes by since the last one, the urgency of doing the kind of things you're saying seeps out.
That's it. You got it in a nutshell, Jeff. The very things that are most important to do will be the most unpopular politically. And I would also say, while we're adding unpopular things, why don't we have a standing TARP? We abolished TARP. So if we get back into the situation we actually need capital injections, got to redo that whole thing. Japan has a standing TARP. Europe has effective standing TARP. there's so many things that you would do in a perfect world, totally not possible politically. Okay, so that's and it's the U.S. political system and its nature that creates this. This is not a problem in Japan. Okay? It's less of a problem in the UK because you have a parliamentary democracy where the government is really the parliament. Okay, most of these issues are, the administration. This new president you're talking about would say, "Yeah, I totally agree with you. We have to do these things, but I'm not going to get any of this to a Congress. I don't control them."
Right.
Different in almost every other political system. So our political system has great virtues, but in terms of dealing with this kind of thing, very difficult.
Hal, thank you very much. That was really fascinating and very, very clear. I appreciate it, and this will be of great value to us.
Jeff, my pleasure. I really enjoyed talking with you.